Let's discuss the top 10 tips for investing smartly and making your first million by 2024. Investing can be intimidating, but with the right strategy, it can be an effective way to build wealth over time. By the end of this video, you'll have the knowledge and tools you need to start investing smartly and work towards your financial goals. The first tip is to start early. The earlier you start investing, investment opportunities abound in today's modern world. Whether you're looking to diversify your portfolio with stocks, bonds, or mutual funds, it all has the potential for great returns and growth if done wisely. The key is to start early. The earlier you start investing, the more time your money has to grow through compound interest. Compounding interest is truly an investor's best friend. It will exponentially increase returns over time. Sure, throwing a big chunk of change into investments can reap excellent rewards quickly. However, starting small each month with continuous compounding earns solid results. Even better, with this video we'll explore why starting early is so critical when it comes to investment success, and how you can get going right away, regardless of budget size. The second tip is to diversify your portfolio. Do you want to make sure your portfolio is diversified and well protected? Did you know that the most successful investors in the world attribute a good portion of their success to a properly diversified portfolio? Diversification is essential for long-term financial stability, as it helps spread out risk and reduces exposure to any one particular investment. By investing in a variety of asset classes such as stocks, bonds, and real estate, you can protect your nest egg from market downturns while still achieving meaningful returns over time. In this video, we will discuss why diversifying your portfolio is important and how you can go about creating one that meets your goals. Keep watching and learn more about why diversification should be an integral part of planning for the future. The third tip is to invest in index funds. These are funds that track a specific market index, like the S&P 500, and provide broad exposure to the stock market. Index funds are a popular investment choice because they offer low fees and low turnover rates, which means less taxes and transaction costs. Additionally, index funds have historically outperformed actively managed funds over the long term. By investing in an index fund, you can take advantage of the growth potential of the stock market while keeping fees and taxes low. The value of investing in index funds is that it allows you to achieve broad diversification with minimal fees. The takeaway here is to consider including index funds in your investment portfolio. The fourth tip is to avoid high fees. When it comes to successfully investing for the future, one of the most important things to consider is fees. High fees can quickly eat away at potential returns, making it difficult for investors to earn money on their investments over time. The truth is that there are low-cost investment options like index funds and ETFs available that allow you to avoid high fees and keep more of your money working for you. In this video, we'll look at why avoiding high fees should be part of any smart investor strategy, and show you exactly how you can do that with real examples. So if you want to not only maximize your gains, but also protect yourself from excessive costs when investing, watch on. The fifth tip is to stay invested for the long term. Don't try to time the market or make short-term investments. Invest for the long term and let your money grow. Historically, the stock market has provided strong returns over the long term. By staying invested for the long term, you give your investments time to grow and recover from market downturns. The value of staying invested for the long term is that it allows you to ride out market fluctuations and take advantage of compounding. Additionally, trying to time the market can be risky and difficult, even for experienced investors. The takeaway here is to have a long-term investment strategy and stick to it, even when the market is volatile. The sixth tip is to educate yourself. Learn about the different investment options available to you and understand the risks associated with each. Educating yourself can help you make informed investment decisions and avoid costly mistakes. There are a variety of resources available to help you learn about investing, including books, articles, podcasts, and online courses. The value of educating yourself is that it gives you the knowledge and confidence to make smart investment choices. The takeaway here is to invest in your own financial literacy to make the most of your investments. The seventh tip is to have an emergency fund. This will help you weather unexpected financial storms without having to dip into your investments. Ideally, your emergency fund should cover 3-6 months of living expenses. Unexpected expenses like medical bills, car repairs, or job loss can quickly derail your financial plans. If you don't have savings set aside, the value of having an emergency fund is that it provides a safety net for you and your family in case of unexpected events. Having an emergency fund gives you the peace of mind to continue investing towards your long-term goals without worrying about short-term setbacks. The takeaway here is to prioritize building an emergency fund before investing too heavily. The eighth tip is to rebalance your portfolio regularly. This means periodically adjusting your investments to maintain your desired asset allocation. Over time, your investments may grow at different rates, causing your portfolio to become unbalanced. By rebalancing, you can ensure that your portfolio remains aligned with your investment goals and risk tolerance. Rebalancing also forces you to sell high and buy low, which can help boost your returns over time. The value of rebalancing your portfolio is that it helps you stay on track towards your financial goals. The takeaway here is to review and adjust your portfolio regularly to maintain balance and optimize your returns. The ninth tip is to consult a financial advisor. A professional can help you create a personalized investment plan and provide guidance along the way. Financial advisors can help you navigate complex investment strategies and provide advice on tax planning, retirement planning, and estate planning. While financial advisors do charge fees, the value of their services can outweigh the cost if they help you make smart investment decisions. The takeaway here is to consider working with a financial advisor if you need help developing a comprehensive investment plan. And finally, the 10th tip is to stay disciplined. Stick to your investment plan and resist the temptation to make emotional decisions based on short-term market fluctuations. Historically, the stock market has provided strong returns over the long term, but it can be volatile in the short term. It's important to stay disciplined and stick to your investment plan, even when the market is down. The value of staying disciplined is that it allows you to stay focused on your long-term goals and avoid costly mistakes. The takeaway here is to stay committed to your investment strategy and keep your eye on the prize: financial freedom. And there you have it, the top 10 tips for investing smartly and making your first million by 2024. Remember to start early, diversify your portfolio, invest in index funds, avoid high fees, stay invested for the long term, educate yourself, have an emergency fund, rebalance your portfolio regularly, consult a financial advisor, and most importantly, stay disciplined. With the right investment strategy and mindset, you can make your first million by 2024 and work towards long-term financial freedom. Thanks for watching.